Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Goslee. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement. Grand Rapids, your resource for a common sense approach to planning, your weekly reminder to be proactive, and your resource for investment, retirement, and all-around planning advice. The team from Cornerstone Retirement Partners brings you some clarity each and every week on the program. This week with us, we have Nolan Goslee, and always a pleasure. We appreciate the time, Nolan. Thanks for being here.
Yeah, thanks for having me, Peter. As we kind of enter into this part of the year, the end of the year, there's a lot of stuff to talk about. So we're going to try and hit on as much as we can today. I hope everybody's ready to go from this most recent round of turkey and stuffing leftovers, and we should be ready to roll.
Yeah, always more material than there is time in the program to cover it. But lucky you're here each and every week to give us some insights and guidance and reminders, and then a constant resource for savers and investors in and around the Grand Rapids area who are taking their planning and their financial future seriously. And ladies and gentlemen, if you've got questions or concerns, if you would like to take the team from Cornerstone Retirement Partners up on the offer for the complimentary review and financial strategy session, pick up the phone, give a call, 616-301-2581. That is 616-301-2581, 616-301-2581. Or you can go online, cornerstone-rp.com, cornerstone-rp.com. Plenty of additional information, resources, archives of previous editions of the program available there as well. Today, we're going to focus on some simple steps to make financial progress. We're also going to talk about some of the concerns that we are hearing about the market and the economy and what proactive savers and investors should be doing as they are looking for opportunities. And it was said once, never let a good crisis go to waste. But Nolan, not that we are in crisis mode or anything right now, but there's always time to look for and identify how we can take advantage of and where there are opportunities in good time or bad, and we need to plan ahead for how to act on those potential opportunities.
Sure. And I mean, it's just like you said, I mean, it's being proactive when talking about these things. It's prepping in advance. It's having your ear close to the ground and making sure that you're anticipating things properly. Now, there are a lot of threats and a lot of concerns to retirement portfolios right now, but a primary one that we're trying to help people alleviate or at least plan for is the eventuality that taxes are going to go up. We'll talk about that intermittently throughout the show today, but that's been a pretty big recurring theme. And it kind of seems like every year or two, there's a different theme here. Taxes are going to get more expensive. Medicare is going to get more expensive. Long-term care insurance, disability, on and on and on. But the theme here is everything is going to get more expensive. So I think with prudent planning and with appropriate planning in the right places, you're certainly right. There's always things that you can do. There's always little things that you can tweak, change, modify on an ongoing basis to make sure that you're staying current with your investments and current with your portfolio.
Well, you mentioned taxes. That has certainly been a buzzword this year. You mentioned inflation. We're all dealing with that on a daily basis. But if you don't mind, I'd like to start with taking a look at the market. And we have all enjoyed the ride that this market has given us and the benefit of the growth that it has provided over the last decade plus now. And if we are properly positioned, we're taking advantage of that. If we've got a good long-term outlook, we should have benefited from that. But we also are constantly, I think, aware when we've got money at risk in the market that can change direction. And so a positive, proactive approach, Nolan, has to be prepared for both.
Right. And I think it does have to be prepared for both. You have to have different goals with your money. And that's something that I always try and talk with folks about when they come in. It's just identifying what goals and what objectives, what stated objectives you want your money to do. Now, everybody knows that over time, stocks usually perform a little bit better than bonds. And I think as a generality, that can be said. Now, depending on which time frame you look at, that can be true or untrue. But if we're talking about averages, risky versus safer assets, risky assets usually outperform. So when we talk about planning and when we talk about this growth, and especially the rapid growth that we've had over the past couple of years coming out of the pandemic, it is important on an ongoing basis to lock in gains, to use your fundamentals of investing and say, well, I'm at a profit. And so it is appropriate to lock in these profits and secure your gains and look for other areas to invest outside of market-based investing in some capacity. So yeah, prudent planning and planning for growth and for contraction is extremely important in retirement.
How do we balance locking in gains, as you stated it, and still having the opportunity for some forward financial progress and continued growth?
Sure. So there are different types of assets that you can get to grow your portfolio. And I'll always just refer back to what's called a style box. And long story short, it classifies stocks in three different categories. One is growth, one is value, and one is a blend of the two. Now, when we want to talk about assets that are really designed for growth, growth stocks are where it's at. Long term, they'll almost always outperform, but they come with an extreme amount of volatility. And so when you have years like 2020, maybe you took a growth stock approach to rebound out of the pandemic. What you do when you rebalance your portfolio is not to say I want less stocks in my portfolio, but maybe instead of growth oriented stocks, I would prefer value. There's a little more stability. There are many more dividends and maybe interest bearing investments. And that's a way that you can engage in the stock market, but maybe in a less risky way. You're still buying equity. You're still buying risky assets, but you're being diligent about it. You're being prudent with your investments in that case.
So growth or decline, rebalancing, really the key here to keeping things in alignment with that long-term financial plan, those goals and objectives that we have set.
Right. And it's especially important when you're taking income off of your portfolio. A lot of folks will say, well, it doesn't matter if the market goes down, it'll always come back. I mean, that's true for you and me, Peter, and we have decades until we want to retire. Well, I mean, maybe not want, but decades until we're going to retire. We have to keep working so that Social Security continues to get money. But as you continue to, I guess, traverse those areas, the areas of growth and the areas of decline, you can find assets that fill those needs in many different places. It's just rebalancing when appropriate, identifying good buying opportunities, and really having strong financial fundamentals when you're managing your money.
So I think that rebalancing is actually potentially more important when there is market movement, and whether it's a long-term trending movement or it is a more immediate or short-term movement, that rebalancing does become all that much more important, both over time and then strategically and tactically to take potentially advantage of a market movement. However, Nolan, what I find and what studies have shown is that people actually tend to rebalance the wrong way oftentimes when they see the market moving one way or another.
Well, sure. That's a lot of when you let emotions get into your investing philosophy. One of the most interesting pieces of information that I was presented at one point was when somebody was talking about what's called the Dalbar Report. The Dalbar Report gauges many different metrics, performance of real estate, performance of stocks, bonds, inflation rate over time. But the Dalbar Report also reports on something interesting, which is individual investor performance. And when we talk about individual investors, most times they're talking about investors that do not have a financial advisor. And this is one of the roles we play as advisors. It's emotional well-being as well as financial well-being. You talk about the emotions getting into investing. Well, a lot of folks, when 2001 and 2008 happened, they sold after they lost 30 or 40% in their portfolios because they didn't want to lose more. Well, what the Dalbar report shows is that those emotional decision-making techniques actually hinder individual performance, and that the individual investor is actually underperforming inflation by a rate of 30 to 40%. So that means that the individual investor is underperforming inflation, which is what we should always be trying to keep up with, or at least get above. And it's because of those emotions. You have a 20-30% loss and you say, I'm done. I don't want to be invested anymore. I want everything in cash because I'm done losing. Well, you're certainly done losing when you go 100% to cash, but you're certainly done gaining when you go 100% to cash as well. You take yourself out of the equation. You no longer have a chance to recover.
So we all hate seeing losses on our statements, but what I'm hearing is that even if we do encounter down markets, there is investment opportunity to be identified during those times.
Right. And a perfect example of that was the pandemic. Kind of when you're going through economic cycles and going through a time of prosperity, it's usually a good idea to not have ultra aggressive portfolios. So, you have good positions in real estate, financial services, utilities, things like that. And then when a crash happens, kind of like the pandemic, you can really identify areas of opportunity or areas of growth that may do better than what you were invested in before, such as technology or healthcare, or some of the cyclical investments that will do quite well. So, it sounds a little bit, when, you talk about it, it sounds a little bit like timing. I would consider it to be more like business cycle investing, where you are really identifying we are in a period of economic turmoil. So there may be a good opportunity out there to buy some investments. It's not timing when you go buy Delta Airlines when a pandemic happens. The stock goes down 90%. You think the company's probably going to be in business later, so you buy some.
Another version of that similar kind of opportunity that we've discussed before is if you are proactively doing tax planning. When corrections happen, when there are down markets, it actually may present us with a pretty unique and can be fantastic opportunity to save a little more and keep a little more of our money.
Yeah, and that specifically is becoming more and more important as we talk to folks. I mean, you come off very strong years in the market. Everybody has a little bit more money than they did a couple years ago. So some of these planning principles become more and more important over time. And one that we're seeing that's becoming extremely important is tax planning. And it's how do you navigate the investment gains that you've been achieving the past few years, or you've worked your entire working career and gotten a real nice bump in your portfolio the last 10 years. Now, how do you continue to manage that money long term? So one of the things that we've been talking with folks about is this tax planning purpose. Have you experienced, or have you, Peter, talked with anybody about some of the changes they're trying to do with Roth conversions and tax qualifications of assets and some of those regulations?
Absolutely. And I think that regardless of really where the market is over the coming several years, it's a good idea for us to plan strategically and proactively for taxes. But particularly if we do see a correction, kind of that opportunity in crisis kind of thing, that may be a good time to talk more specifically, or to convert more of our tax deferred dollars to Roth so that any recovery that happens can happen tax-free.
Yeah. The recovery can then happen tax-free in the Roth. You can become much more aggressive if you would like to within a Roth IRA. I know tons of folks that, that we've been helping create conversion strategies over the past few years. A lot of them have just taken their Roth IRAs and they are strictly only stock portfolios at this time. And they're just taking advantage of the incredible growth in the market right now and understanding once you move the money from the traditional IRA over into the Roth, or once you put money into the Roth, you never have to pay tax on it ever again. So yeah, navigating that IRAs and the tax qualification of those IRAs in particular is becoming much more important.
Identifying opportunities in a complex financial world is all about planning and being proactive, having a long-term time horizon, but understanding that there can be executable actions along the way when those opportunities present themselves, knowing and understanding those ahead of time. And if you'd like some insight into this, or if you'd like to review the comprehensive plan that you have for your financial future, pick up the phone, give a call to Nolan Goslee and the team from Cornerstone Retirement Partners, 616-301-2581, 616-301-2581, 616-301-2581. Visit online, cornerstone-rp.com, cornerstone-rp.com. There's a great chat feature right there. You can talk with the team, but the easiest way to be in touch, pick up the phone now and give a call, 616-301-2581. Quick break. We'll come back with more with Nolan Goslee on Your Course to Retirement.
Can you hear that? That's the sound of you setting off on new adventures, on the trip of a lifetime that you always dreamed you'd take in your retirement. You worked hard to be able to enjoy these kinds of experiences, and now you can. In fact, you can even enjoy a few upgrades and extras along the way. A big part of this is due to the confidence you feel in the careful planning and mapping out of your retirement with your fiduciary team at Cornerstone Retirement Partners. By sitting down with Ron, Nolan, and the team at Cornerstone Retirement Partners, you created your plan and carefully looked at your income, investments, taxes, health care plan, and it looks like you'll even have a little left over to leave a positive legacy for your loved ones. Now that's enjoying retirement with confidence. For your complimentary planning review and written retirement income map, set up a time to speak with Cornerstone Retirement Partners at 616-301-2581. That's 616-301-2581. Or visit cornerstone-rp.com for your complimentary investment analysis and retirement planning session.
And we're back here on Your Course to Retirement. Peter Rashan here, along with Nolan Goslee, member of the team, partner there at Cornerstone Retirement Partners, Grand Rapids, your resource for clarity in your planning process, from the investment, the financial, the retirement planning. They are your source for answers and a common sense approach. Pick up the phone, give them a call. They're at Cornerstone Retirement Partners, 616-301-2581, 616-301-2581. Hard to believe we're in the final month of 2021. We are rapidly rounding home here toward a new year. A lot of people want to get that financial kind of house in order, feel a little bit better about what they're going to be doing into the new year. It starts with being proactive and planning in advance. So let's get the ball rolling on that now. We're talking with Nolan today about identifying some opportunities. Now, sometimes not losing is winning. And a lot of people, Nolan, right now are looking for some opportunities to achieve some protection for what we've been able to work so hard and build up into this point. So are there some good opportunities out there right now for protection of our assets without kind of stalling them and having them gather dust and doing nothing?
Sure. So when we talk about protection, it's important just to identify what we really want. So when you say protection, do you want guarantees? Do you want just the assumption that an asset is safe? Because with almost all investing, there's going to be some sort of risk. You can put money in cash, but the risk is inflation will eat away at it. You can bury it in the backyard, but the risk is you forget you buried it back there, and so on and so forth. So even the safest investments, there's always going to be at least some risk associated. Now, I always try and present it in a couple different ways. First and foremost, you say, what am I really trying to do? Am I trying to go 100% for asset protection? Am I trying to position assets better for my heirs and for my legacy planning? Or am I simply trying to have a little bit more money, and just a little bit more money 2 or 3 years from now? So maybe I can invest when I feel a little bit more positive about the economic outlook that we're in. So I would say first and foremost, it's just really important to identify what we mean and what we want with our protection.
Nolan, I know that traditionally growth-oriented investors are shooting to match or beat the market, and the expectation for returns can be 8, 10, 12% or more. But I'm hearing from a lot of people right now that they don't want to shoot for those big returns and would be very satisfied if they could just find something that kept up reasonably with inflation, something that generated 3, 4, or 5%. And that kind of balance is possible in the financial world, correct?
Correct. Yep. So we have a couple different ways to go about it. If we're talking about principal protection only, there's banking instruments that you can use for some type of protection. The most common ones I would say are CDs and money market accounts, neither of which are paying an incredible amount right now. We're in a very low yield environment, and that just means that there's not a lot of interest being kicked off of investments like this. Typical investors here in West Michigan, when they're looking for something like that, will just go open up like a max checking account and earn 2, 3, 4% or something. But most times on something like that, there's a cap on how much you can have in the account. So if we want to go somewhere where maybe there aren't caps and you earn somewhere 2, 3, 4, maybe even 5%, a lot of folks are going to insurance products at this point. What an insurance product will do is it increases your risk just a little bit because you're investing in an insurance company rather than just investing into US government debt, like treasury bonds. But in exchange for that small amount of risk, you get a little bit of participation in the markets or a slightly higher rate of return with fixed accounts, where maybe over 3 years you're earning 2 or 2.5% instead of like a 3-year CD where you're only earning about 1.25 or 1.5%.
Overall, Nolan, as you're looking at the balance of risk and protection and safety for our dollars, and then what each one can bring as advantages or disadvantages, is there any kind of rule of thumb or gauge for how much we should be risking and how much we should have protected?
Sure. So over time, there's been a lot of rules that have been touted as good for trying to figure that out. The easiest one that I've been able to explain to people is just the rule of 100. Now, it doesn't work for everybody, but here's the basic principle. You take the number 100, you subtract your age, and that's approximately how much you should have in risky assets in your own portfolio. So if you're a 60-year-old person and you have $1 million, you subtract your age, and that's 40. So you should have roughly 40% or $400,000 in risky assets. Now, some people have said that's too conservative, so there's a rule of 110 and rule of 120 and so on and so forth, and everybody can have a little more stock and a little more bond anytime they want to. But as far as a rule of thumb, what that means is as you get older, your portfolio should get less aggressive. And that's what the principle really means there. So it's not necessarily, am I using the right rule of 100, 110, 120, but it's, am I comfortable with the amount of my portfolio that's susceptible to risk, and is the risk worth it to get the expected return?
That percentage though, Nolan, I like equating it to dollar value. So if I am that 60-year-old with $1 million, I've followed that rule, and $400,000 is therefore at risk. And then the market takes a 25% correction or a 50% correction, which is absolutely possible. We saw it twice in the beginning of the 2000s, the dot-com bubble and the Great Recession. But if we take a 25% loss, which we saw during the midst of COVID, actually even more than that, but that's $100,000 that I've lost. And if I'm 60 years old and I've got my $1 million, I may not want to have the possibility of $100,000 loss. And if the market corrects 50% and I've got 400,000 at risk, then I could have lost 200,000. Does that put things in a different light and perspective when you quantify it that way versus just talking about it as percentages? And is that something that you do quantify for clients and those who are looking for guidance there at the Cornerstone Retirement Partners?
Yes, that in particular is incredibly important because we do what's called a risk profile questionnaire every time we sit down with somebody. We ask you if you have a really sharp short-term downturn or a really prolonged deep downturn, what would your gut reaction be? And a whole lot of people that answer that question for me say their gut reaction would be to wait and see. Now, that sounds well and good until you actually lose the money. And then your wait and see turns into a moderate panic. And then if your wait and see is supposed to be 3 months long, but you've wait and saw for a month and a half, and oh shoot, I'm down 35% during COVID. Well, losing it is actually different than saying you're comfortable losing it. And so I always will try to identify with folks what the purpose of your money is. Do you have a short time until you want to lose it, or a long time until you want to lose it? Or use it. You don't have to lose your money, obviously, but it is important to actually quantify it. Say, okay, if your portfolio lost this many dollars, what would your response be? How would you react? And if somebody shifts in their chair, they're a little uncomfortable, they probably aren't comfortable with those types of risks or losses.
Well, Nolan, I know you don't know the future with certainty, and the crystal balls in the shop are broken, what have you, but we have seen 16 different bear markets over the last 100 years. And a bear market is quantified as a 20% loss or greater. And those things don't happen in 24 hours or in 1 week's period of time. Oftentimes it's sort of a slow drip, a year and a half from the top of a market down to the bottom of a bear market. And oftentimes it's far greater than 20%, at least past history would tell us that. All that being said, then there's the time for recovery. That's a lot of time lost. What do you think is perhaps the future of the market? Where do you see, and what's the likelihood of seeing a market correction? Or is it just something that we should always have a plan and contingency for?
Sure. So I will always position it this way. Number one, I expect that the United States will continue to be a world power. I think that almost everybody can agree on that. So regardless of where you think any administration is taking us, I was in the Army and went through several administrations, and I have a hefty amount of skepticism that anybody's going to do it the right way. But it's important to have appropriate expectations. So I expect the U.S. will continue to be a prominent world power. I expect that we will continue to issue a whole bunch of debt on an ongoing basis. People are going to continue getting older. Less people are going to want to continue to work. And that's kind of going to be the theme. Now, you can let that happen to you, or you can plan for it. And so if these are all things that we can identify as potential trends and identify as areas of opportunity, then we can go find ways to make money within them, no matter how bad it gets. You just have to be diligent. You have to want to work at it on an ongoing basis. I don't know quite where we're going, but we have to take a little bit of ownership and just assume that everything's going to continue the way that it always has. Taxes are going to go up, inflation's going to go up, healthcare costs are going to go up. We just have to plan for it.
Yeah, I think every generation, every decade, it seems, has at least one moment in time where people are concerned that this is the end. We've hit the peak and we're on the decline from here. And then life goes on, yeah. And we have to plan for life to go on, but have the contingency in place to identify some opportunities along the way as we see regular corrections and market cycles occur. And we're certain to do so into the future. Nolan Goslee, the team there at Cornerstone Retirement Partners, they're your resource, ladies and gentlemen, for that common sense approach and true guidance and perspective during those times, both good and bad, to make sure that you are still making progress to your long-term financial and retirement goals. Pick up the phone, give them a call at 616-301-2581. The true value of this program is that they offer that guidance and perspective to you individually. If you'd like to get a plan put together, double check your current plan, have a retirement, investment, financial review and strategy session, they do not charge for that. They waive all consultation fees for any of that planning that's involved for radio show listeners. Pick up the phone and give a call, 616-301-2581, 616-301-2581 to start that conversation, have that initial review and strategy session. 616-301-2581. Quick break. We'll be back with more here on Your Course to Retirement with Nolan Goslee, looking for those opportunities in just a moment.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Goslee. Cornerstone Retirement Partners are planning today for the potential of tomorrow. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
And welcome back into the program. This is Your Course to Retirement with Grand Rapids Resource for a common sense approach to planning, helping to clarify the complicated financial, economic, and retirement planning world is the team from Cornerstone Retirement Partners. Always privileged to be joined by Nolan Goslee on the program today, talking about rounding home, getting close to the end of the year, and looking for opportunities for our money to help us achieve the goals that are important to us, maybe do a little bit more, be a little bit more efficient. And Nolan, we were talking during that break there that a lot of people are making another transition, not just to a new year, but beginning to think about a transition to a different phase of life in retirement, something that you deal with a great deal. In fact, kind of the niche there at Cornerstone Retirement Partners is helping people to map out and make that transition. But a big part of that is looking for opportunities to create income. And it truly is a different phase and almost requires a fresh and different look and approach to the way that we're handling our finances and our money.
Yeah, income planning becomes more and more important as you become closer and closer to the age that you're drawing income. You have to, at some point, begin planning for when you're going to take money out of your accounts.
It makes so much sense, but in the financial world, a lot of times that important fact is overlooked with people making that transition.
Yeah, and it's a huge hurdle that just people do not expect or don't understand that they're going to have to get ready for. I mean, you've spent 20, 30, 40 years working, saving, investing your money in the best growth oriented investments that you can possibly find. And now you need to turn your entire portfolio on its head. And not only do you need to figure out how to stop working and still fill up those 40 hours a week, but you need to figure out how to manage your investments alongside that and actually start generating income from your investments. And that income generation, I mean, that's the most important part of retirement planning. I mean, generating income and figuring out where your next dollar is going to come from, that's what retirement planning is for. That's what it's about.
And there at Cornerstone Retirement Partners, you help people map out that process. If you remember math class, the order of operations of any math equation matters in getting the correct answer. That's part of the process there, is that you are really putting that written retirement income plan together and carefully examining the order of operations in how to make that transition and then achieve the right answer of the income that we need.
Yeah, and a lot of that is just, just talking about what you have and what kind of money you need, and then it's our job essentially at that point to say, okay, based on where we expect taxes to go, based on where we expect healthcare to go, because we do Medicare planning here in the office, based on where we expect all of these other things to go, you start drawing out of account A first, account B second, then you start drawing Social Security, and then you start taking out of this account, and then you claim your pension, so on and so forth, so that you know to the month when during your retirement you're going to start drawing these different sources of income. And a lot of retirees have 5, 6, 7 different types of income between 2 Social Securities, an occasional pension, and then jobs, hobbies, and other income generating activities. It's incredibly important to know not only where that money is going to come from, but how it's going to be taxed and how much you actually get to keep.
Well, as we are talking about making this transition to income and how to identify opportunities for income, I came across this recent Kiplinger article, and it was 11 money moves to make in the decade before you retire. A big one was figuring out the lifestyle that you envisioned. They also mentioned not to make huge and major changes to that lifestyle in that decade, but the map part of that, the order of operations, they actually detailed that in one of the 11 moves that said know your number. But when they said know your retirement number, they mentioned the lump sum, but went up about it in a way of reverse engineering and mapping it out, not as a factor of the lump sum, but as a factor of the income that lump sum could create.
Yeah, and I don't know, I guess understanding and delineating all of those different income sources is the point of income planning. When you talk about creating income, and when you talk about creating investment opportunities for income, I mean, that article and many others will just talk about the risks associated with one plan, right? And it's not being adaptable and not creating a plan that's changing and constantly evolving with the markets. I mean, the markets or not the markets. I mean, how similar are we as far as the investment mix that we have available right now than we were 10 years ago? I mean, all investments look completely different. Insurance products, stocks, bonds, everything is performing different than it was during 2011. And so I think it's just important as you're planning for this income to understand, okay, Social Security is going to be a pretty steady and pretty reliable source of income for me. And that's going to take care of so much of my lifestyle. And then I can maybe create a variable income strategy with the other portion of my assets. So maybe I can meet my investment or retirement lifestyle on an annual basis, but some years when I do quite well, I can do a little extra, maybe go on an extra trip or two, or kind of plan around it that way. But variable income planning is becoming more and more important as time goes on.
Reminds me of another resource that you had discussed and made available on the program. It's kind of a quick report on Are You Ready? It's like 12 questions to know if we are prepared for retirement. And that article was 11 factors, 11 money moves to make, but very similar to those 12 questions on the Are You Ready report that is available there at Cornerstone Retirement Partners.
Right. And some of the things that are on that list that some people just either overlook or they don't consider up front. And some of the things that are either becoming more important or I think are pretty important that people overlook is long-term income planning. So, there's a 95% chance that one of two spouses is going to live to their 90s. And that's important for Social Security planning. However, what's also important to know is that if something happens to one spouse, one of the Social Security benefits goes away. And so it's important when you're going through this income planning, and it's one of the 12 questions that we ask you is, are you prepared for an income stream to go away? Or if pensions are included, are you prepared for potentially two income streams to go away, or for one to be cut in half? Maximizing Social Security income, maximizing when you draw it, how you draw it, appropriate strategies. Those are all incredibly important. And the point of all of it is to just keep as much money as you've worked for. Take home as much as you possibly can from what you've accumulated over your working career. And that's what we try and do.
In order to be prepared for and as confident as possible in retirement, you really do need ahead of time and proactively to think about some of the things that could or will go wrong in retirement. A big one of those is losing a couple streams of income. And as we are making the decision for when and how to claim and collect Social Security, unfortunately, a lot of people are not aware that the consequences of that and the way that the Social Security system works is that one person only receives one check, and some income will disappear between a married couple when one of them passes.
Yeah, or another thing that just people don't know is if you claim your Social Security early, if you claim at 62 and then inherit your spousal benefit, if your spouse passes away, it could reduce their benefit too. And so there's always these little finite pieces, especially within the Social Security program, but a lot of other retirement programs, pensions included, where it's just very important to consider the 20 or 30 year long effect of a decision that you're making today. It's a little bit more involved with what's my break even and when do I actually, make money from delaying this benefit or whatever. So it's like you said, it's triggering that income, one after another. This is where each income stream is going to come from. And if one goes away, if two go away, if three go away, what am I going to do about it? Because you have to have contingency plans.
Well, as we are talking about identifying opportunities, and specifically in this segment, opportunities to create income, obviously Social Security and pensions are a fantastic opportunity, but generally don't cover everything that a retiree needs to maintain their standard of living in retirement. And that's why we have built our personal savings as well. Where are the opportunities, Nolan, with the investment portfolio, the personal savings, our wealth, our life savings, to create the additional income that is needed in this low interest rate, low yield world?
Sure. So the I guess biggest crux of the matter is people used to go to the U.S. government for yield. People used to go buy government debt to get yield. And what I mean by that is you used to go buy a 2-year, 5-year, 10-year U.S. Treasury, and they'd give you a few % interest per year. Well, right now, the 1-year U.S. Treasury is kicking off 1/10%. I mean, if no retiree I know is prepared to live off of 0.1% of their portfolio. So when we talk about yield and when we talk about income, it's got to come in one of 3 ways, really, in my opinion. Way number 1 is that you just invest it in risky assets and sell those assets to generate income. Now, that's not really income generation. It's not something that is technically income. I mean, you're buying and selling, you're trading, and hopefully if you have good years, you have money to tap into.
Harvesting gains when they're
harvesting
available.
gains, right? It's not necessarily generating income, although some people may consider it to be apples to apples, neither here nor there. So option number 2, which is what we've been doing a little bit more of lately, is investing into custom bonds and custom note products. And so what these are is they're typically like a bond, but are short in duration and usually have some terms associated with them where they have a little bit of potential for loss, but much higher yield than your typical government bond. And so it's kind of like a hybrid product where it's, a little bit risky. You do take some risks with it, but the yield or the income that you generate off of this is usually, 3, 4, 5 times what a U.S. government bond would be, even at its best right now. So, that's kind of looking for new product, looking for new types of investment to generate that income. And then third, and I think probably most traditionally, you can pick, insurance products, and a lot of people will pick annuities. Now, annuities get a bad rap because I think they're used inappropriately some ways. But when I'm talking about an annuity for income, I talk about annuities most often when they have an income rider attached to them. And this income rider may say, if you take out this annuity product for X dollars, we will pay you a percentage of those dollars each and every year in the form of income. Now, that income will last forever. And that is the unique thing with an annuity product. No other investment can you go get a guaranteed forever stream of income that you would be able to with an annuity.
And when you say forever, can you quantify that? I mean, sure. Forever and ever?
So I, as a 55, 60-year-old person, I go put $200,000 in an annuity. They say they're going to give me 5% per year income. That sounds really good. So I start taking out my 5% income. Well, if I live for 20 years, I've now taken out 100%. Okay. And that's just assuming that the annuity gains 0% interest and doesn't grow at all. Well, the cool thing about the income stream with an annuity is if you draw all the money out of it, the income continues. Quantifiably, you draw your account down to $0 and the company is contractually obligated to continue paying you until you die. So that means you can leverage your money where, you're taking a little bit of risk by depositing a large amount up front, but your risk is alleviated the longer you survive. So if you have a large amount of capital or longevity in your family, or want a hybrid approach of, risky stock investing in something that's really solid and guaranteed, annuities have a wonderful place in people's portfolios when used in that manner.
When you say annuities have that unique quality that they can provide that forever or lifetime income, whereas any other alternative kind of account or investment, if it reaches a zero balance, that's the end. That's it. You are no longer making any kind of rate of return. The continued income payments for the duration of your lifetime thereafter really constitute a different type of return on investment with an annuity. It's just kind of structured differently along the way.
Yeah, it's totally structured different. And I mean, it's the difference there in what type of planning you want to do and how many risks you want to take off the table. Now, we can go use historical data as much as we want to make something make sense. But what I always like to compare people to is just the most recent 20-year period we've had in the markets. Now, if you retired in 2000 and you had a 100% stock-based portfolio, which the stock market averages 7 or 8% per year, depending on who you talk to. If you invested from 2000 to 2010, you probably did not have a very successful retirement. And the reason for that is because your 100% stock portfolio had two 50% declines in a 10-year period with pretty slow recoveries. Okay. And what that means is you were taking money off of that portfolio too. You were selling your stocks to generate income. So you lose 50% and then you sell 5% more. So now you've lost 55%. Now your hole's even deeper to get out of, and it's very difficult to recover. Whereas 100% stock portfolio over the last 10 years probably went gangbusters. You probably averaged 12, 13%. And you look like a genius when you talk to all of your friends and talk about your retirement portfolio and how much income you're generating off this thing. Well, the cool thing is with an annuity or an annuity hybrid concept, or even using it as a part of your income, those two 10-year periods would not matter with an annuity that's meant for income. It doesn't matter if you have two 50% declines or two 40% increase periods during that 10-year period. The annuity, being an income generating tool specifically guaranteed by the annuity company to generate that income, takes away the risk that your portfolio goes down 40, 50, 60%, and you have to still take money off the top. So it accomplishes 2, 3, 4 things all at the same time as far as risk alleviation and income sustainability.
We are talking about identifying some strategic financial opportunities today with Nolan Goslee of Cornerstone Retirement Partners. If you've got any questions, you'd like to find out more, you'd like to take advantage of the opportunity for a complimentary review and strategy session, if you'd like to get your game plan for retirement mapped out and in writing, pick up the phone and give a call, 616-301-2581, 616-301-2581. When we come back from the break, Nolan, I've got a question about one other methodology I've heard as an opportunity to create income. And then I want to talk about that income versus the current inflation that we are seeing, and if we need to rethink about that or think about that in a different way. So don't go anywhere, ladies and gentlemen. As always, plenty more valuable information to come on the remaining portion of the program here on Your Course to Retirement. 616-301-2581, the number to call. Great time to place that call during the break. We'll be right back.
Can you hear that? That's the sound of you setting off on new adventures on the trip of a lifetime that you always dreamed you'd take in your retirement. You worked hard to be able to enjoy these kinds of experiences, and now you can. In fact, you can even enjoy a few upgrades and extras along the way. A big part of this is due to the confidence you feel in the careful planning and mapping out of your retirement with your fiduciary team at Cornerstone Retirement Partners. By sitting down with Ron, Nolan, and the team at Cornerstone Retirement Partners, you created your plan and carefully looked at your income, investments, taxes, health care plan, and it looks like you'll even have a little left over to leave a positive legacy for your loved ones. Now that's enjoying retirement with confidence. For your complimentary planning review and written retirement income map, set up a time to speak with Cornerstone Retirement Partners at 616-301-2581. 616-301-2581. That's 616-301-2581. Or visit cornerstone-rp.com for your complimentary investment analysis and retirement planning session.
We'll come back and hit it. All right, here we go. 5, 4, 3, 2, 1. And welcome back into the program. We are so privileged to be joined by Nolan Goslee of Cornerstone Retirement Partners, your resource, ladies and gentlemen, for that common sense approach to planning. And today on the program, we have been talking about how to plan strategically and proactively to take advantage of financial opportunities. We've talked about opportunities in the market. We've talked about opportunities for protection. We've talked about tax opportunities. And specifically in the last segment, we were talking about opportunities to create income, to leverage your dollars and create more income from those dollars. Nolan, you mentioned taking gains when they are available. You mentioned yield from bonds or other income producing assets. One other methodology that I've heard a lot about and was wondering if you could discuss the benefits, the disadvantages, strengths, and weaknesses, dividend producing stocks. Because I know a lot of traditional income oriented investors have followed this method of dividend producing stocks. Is it a good thought or a bad thought, or where do your thoughts lie on it?
Sure. So income producing stocks, dividend producing stocks. I mean, everything we talk about here on this program is just tools in your tool belt. And every tool has a different application, and some are good for some folks and some are good for other folks and some are bad for everybody. But when we talk about dividend paying stocks, it's important to mention a couple things. Number one, if you have a bunch of dividend paying stocks, but you have them in a taxable account, and that's where you want to draw your income from, one important thing is just to understand how dividends are going to be taxed. So if you have a stock portfolio and it's based on dividend generation, you want a bunch of what are called qualified dividends, which typically give you better tax treatment. Another thing with dividend stocks that a lot of people are not aware of is that they are actually stocks. They may sound like they're secure and may sound like they're very stable because they kick off a dividend. However, they are still based on company projected earnings. And so even if a company like Procter & Gamble or Iron Mountain or any of these other stocks that kick off dividends and have kicked them off for a very, very long time, they're not obligated to give you those dividends if you're a common stockholder. They're not obligated to give anybody dividends unless you own preferred stock. And then even then, if you're not profitable, you don't have to give preferred stockholders their dividends. So creating a portfolio on dividends is good if it's used in the right way. And you just need to understand what significant drawbacks there are to it. There can be volatility in years where value stocks don't do very well. Dividend stocks usually don't do very well. And in years where there's a lot of stock volatility, it usually bleeds into that sector as well. So you can earn 3, 4, 5, 6, 7% on dividend paying stocks, but they also may vary 10, 20, 30% on a share price basis, which can then affect your income.
That they are a product of the profits of the company. And there have been even long-standing, large, stable companies that may not be profitable in a year or two throughout time. And then at the same time, the share price often is hurt if the company is not profitable. So the value of the total portfolio. And when we've seen this, Nolan, a lot of times simultaneously as cutting, reducing, or eliminating dividends, people then don't have the capital to go out and reproduce that income because the share price has fallen at the same time. So just something to keep in mind there. And specifically, Nolan, as we are looking at opportunities, I did want to talk about a concern as we round home here and get to the near end of the program that a lot of people are having about inflation. Now, are there opportunities out there to do anything about inflation or to at least address inflation with how we are positioning our assets and generating our income?
Yeah, a couple different ways. A lot of folks will go to what are called Treasury inflation protected securities, TIPS. These are technically government bonds that are specifically designed to alleviate inflation risk in a portfolio. They are meant to gently outpace inflation. And I say gently because these things will never earn you 10%. I don't think inflation will ever get up that high, but these things will never get up that high either. You know, a lot of people will try and solve inflation with stock appreciation, and that works as long as the stock market's strong. You can have a very weak stock market and you can have very high inflation. Just ask people that had to deal with volatility during the 70s and 80s. So, you know, the two don't always go hand in hand, or they do. I think it's just very important that you understand what your own inflation rate is as well. You may be told inflation is 5%, but if your cost of living only goes up by 1%, then your rate of inflation isn't 5%, it's 1%. So it's important also just to realize everybody's individual situation is different. Everybody's costs of living change differently every single year. And that's one of the reasons that you want to hire a professional to work with, so that they can help you stay on top of those changes, and so that we can help you manage a 10 or 20 or 30 year long retirement. Because it's not 5 years. 5 years is simple to plan for. 30 years is pretty tough.
And Nolan, that's why finally one of the best opportunities is to specifically designate money according to that timeline, to have it mapped out and time optimized so that the dollars that you want are there when you need them into your financial future. And that's a big part of that income planning process and the retirement strategy session that you offer there at Cornerstone Retirement Partners.
For sure. For sure. Yeah. And it becomes more and more important every day because, believe it or not, our government and the way that they pass administration and law does not seem like it's getting any easier to understand. So we're here to try and help you wade through it. We're here to wade through it right there with you. So just give us a call. We're happy to help in any way that we possibly can. And, you know, we'll be here forever. So.
As always, great information on the program, but also, as always, the true power and the value of this information is putting it into action and being proactive. And this can be the time of year where thoughts of our financial planning slip, but we shouldn't allow that to be the case. This is actually the time of year where we can make a big impact on to moving forward into next year and to future years beyond, by being strategic and proactive. And the team from Cornerstone Retirement Partners there is your resource to help you in that planning process. Pick up the phone and give them a call, 616-301-2581, 616-301-2581. You can also always go online, cornerstone-rp.com, cornerstone-rp.com. Fantastic resources and information there, as well as your opportunity to get in touch with the team and request the time to sit down and look at your unique, specific individual situation. Comprehensive planning approach there from Cornerstone Retirement Partners available to you. They waive all costs associated with that initial review and strategy session and the plan design. Pick up the phone, give them a call, 616-301-2581. That's 616-301-2581. Nolan, as always, a pleasure. We appreciate you being here, providing the guidance that you do.
Thanks, Peter. Appreciate it.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.